Good evening, everyone. It is a pleasure to welcome all of you to this special session on Integrated Business Solutions paper organized by Board of Studies Academic. Students, let me begin with a simple thought. This paper is not about how much you know, it is about how well you can connect what you know. Many students approach IBS with the mindset that it is just an extension of subjects they have already studied at CA final level or set A and set B. In reality, it is subject a business is operating in is to compete harder, reduce prices, increase marketing, capture market share. But real strategic maturity lies in asking a different question: can profitability be improved without competing harder? This is where just a strategy, it becomes a compliance, funding, and risk management question. A cross-border investment, for instance, is not merely about cost advantage. It brings in regulatory norms, thresholds, approval requirements, and currency exposures. Funding decisions are no longer straightforward. They require a view on interest cycle, forex volatility, and risk tools. This is the essence of IBS paper. Understanding that every decision carries layer. You have to think holistically. Another important dimension often overlooked is trade-offs. There is no perfect decision, only well-balanced ones. For example, a funding option that is cheaper may introduce high risk. A compliant structure may reduce flexibility. A strategic move may improve margins but lower down your working capital. Your role is not to find a perfect answer but to recommend a stronger one. Now, let me address a very practical aspect of this paper. Many students underestimate the importance of set A and B because they don't appear core at first glance. However, IBS doesn't differentiate between core and set A and set B. It evaluates how you integrate them, you integrate all seven papers in this one paper. Conceptual clarity is biggest assets here. The open book exam is not a shortcut. It is a support system. Without clarity, it becomes a distraction. With clarity, it becomes a very powerful tool. Also, I would strongly encourage you to treat your preparation in a slightly unconventional way. Instead of limiting yourself to current group, retain selective deep in key subjects from group 1. This continuity of understanding significantly enhance your ability to analyze case holistically. Another critical aspect is governance and emerging frameworks. In today's environment, decisions are not judged by profitability but by their sustainability, transparency, and compliance with evolving regulations. Whether it is a board structure, disclosure, or stakeholder accountability, these elements are no longer theoretical. They shape real business solutions. Similarly, sector specific context matters. A listed company operates under different regulatory norms than an unlisted company. A pharma company deals with different accounting sensitivities compared to a manufacturer entity. IBS expect you to be sensitive to such context. We are privileged to have with us CA Amit sir. He brings with him rich experience across global audits, governance frameworks, and large scale audit delivery models. His practical exposure will help bridge the gap between theory and real world issues. Today's session is designed to be interactive. I would encourage you not to approach the case as a question to be solved, but as a situation to be understood. If you disagree with a perspective or you can question if something is unclear, raise your doubt. Now, that is where real learning happens. Let us use the session to think deeper, connect better, and approach problem the way a professional do. With that, let us begin today's discussion. Sir, over to you.
Thanks a lot, Deepak ji, for introducing me and the concepts around this particular subject. Uh, a, a very good evening to all the students and the future members of the institute. And with this particular session on IBS today, we will be covering two case studies. We will cover one case study and then we will have a small short break and then thereafter the second case study. That's the agenda of today's session. As rightfully mentioned by Deepak ji, that this particular subject, whenever we think about, it is not at all a kind of an exam that you need to appear. I always think IBS as a practical situation, a practical situation whereby in the case study, a client is sitting in front of you and a client is giving you a background. That's the whole purpose of designing a case study, so that when you will go start going through the case study, at least you know that what is the client's concerns are, what is exactly the problem they are facing. As a chartered accountant, we are not expected only to solve the problems because the client wants us to do the value addition as well in the existing solutions. So at times, because there is so much of access to the information that is available in the market, clients at times they come with a lot of information available in their hands already. And then they are not expecting as a chartered accountant we to do a solution to the problem. They want us to add the value in the solutions that they have in their mind. These kind of exams, IBS kind of exams, they give you a practical approach on how to utilize all the concepts that we have studied among various subjects and how to practically implement them in terms of solving a problem of a client or doing the value addition in the existing solutions. That's what we are supposed to do basically. So whenever you approach IBS exam, don't approach it as a theoretical exam. It is a very practical exam, and always remember the case study that is there. It is more or less like a discussion that you are having with the client. The client is giving you the background, and the questions which are there, be it descriptive or I will say optional, they are always there so that the client is asking you those questions. So they are putting you in a practical situation, seeking some advice from you as a chartered accountant. So with this background, let's start with today's first case study and let's see that what is the client is explaining in terms of the background and then what are the questions the client has come up with to you as to seek your consultancy on those problems. I'm just sharing my screen. I hope it is visible.
Yes, sir. Visible.
Okay. So this is the case study number 21. As you are aware, we already have case study digest. So there are multiple case studies which are available. And it is highly recommended to kind of start going through these case studies to prepare for IBS kind of practical exams. These case studies, they not only give you a kind of an insight that what can be the real life scenarios, but they also give you some inputs on how to draft the solutions. This is a very practical kind of a concern which we have noticed after having multiple conversations with the students, that they at times need guidance on how to draft the answers of these case studies. So these digests along with the solutions they are available. So once you will start going through these kind of case studies, you will get an insight also that how to write the answers, how to write the solutions, how to address the practical life situations. Okay, with this we are starting with the case study 21. This case study that we are going to cover in the first session today is about Cycles India Limited, which in our a kind of a situation will keep on quoting as CIL. This company, which is under consideration, is manufacturing cycles for adults and children. So both kind of cycles are there. Now, this cycle CIL is a company. So this is our client. Try to understand it as a practical situation. They will explain certain things to you, and then they will have some questions which we need to address as a consultant, as an advisor to them. So they are into the manufacturing of cycles for both adults and children. Now they have given us some information about the cycles they are making for the children. So you see, these are the some information which is available for this kind of a manufacturer. Now, what is the information that they have made available to us is that they have a monthly demand and production which is 20,000. So demand is also equivalent to the production. But now they are saying that they have two types of CVP analysis, which is cost, volume, and profit analysis. All the manufacturing companies, they do these kind of analysis to see. You must have, you can recall about the economy of scales, etc. The more kind of you will be manufacturing, the better the economy of scales will bring. You can start negotiating with better terms with your vendors. The fixed cost per unit may reduce. There are a lot of economy of scales, right? And this all comes under the cost, volume, profit analysis. So they are doing the CVP analysis basis two ways. The one is known as the traditional, while the other one is known as the activity based. Now this activity based is absolutely different than the traditional, because in the traditional kind of a setup, whatever the total fixed cost used to be there, we used to allocate that fixed cost to the production. This is what the traditional a kind of a allocation of the costing used to happen. In the activity based, what we do is each type of fixed cost is being allocated or identified to a respective activity, and then we are allocating this basis that activity, rather than accumulating all the fixed assets and fixed cost and then accumulating or allocating it to the respective units. In the activity based costing, we identify the fixed cost and we relate it to respective activity, and then on the basis of those activities that we have identified, we allocate our fixed cost. So in both these models, let's see how the CVP analysis, or what are the information that the company is making available to you. So first of all, they are saying that the monthly demand and the production is 20,000 units. Selling price for each cycle. Remember, this is for children. So they are saying the selling price for each cycle, it will remain same, because the activity or the traditional cost allocation method is for the allocating the cost on the production. It is never about the selling price. Selling price will remain same under both of them. Variable cost, it will remain same. So 15,000 and 15,000 variable cost per unit is there. Now the fixed cost per month as identified under each cost system is 20 lakh and 16 lakhs, right? So what is happening? Now you see the difference is basically, so this 20 lakh is the total fixed cost that we have. And even if we are doing the activity based costing, the amount will not change, because this will remain the total fixed cost for the company. It is just like that fixed cost can be identified to respective activities. So we can clearly see in the activity based costing, the company is saying that our fixed cost per month is 16 lakhs, while the 4 lakh extra fixed cost, it is related to an activity, and that activity is known as setups. So the number of setups that the company is having is 800, and cost per setup is 500. So the 4 lakh rupees of fixed cost, they have identified it to an activity. So they are saying the 16 lakh will remain. This is indifferent. Whatever production will happen, the 16 lakh is fixed. While in the traditional costing, 20 lakh was considered as fixed. In this activity based, they are fixing 16 lakh, while they are saying that the 4 lakh rupees of a cost, it depends on the one of the activity known as setups. So if we will reduce the setups, the fixed cost will reduce. If we will increase the setups, the setup cost will increase. Okay, so I hope you can understand this is basically a traditional method and this is an activity based model. Let's go to the more information that the client is giving you. So in the next step, client is saying that the fixed cost of 20 lakh per month under traditional CVP MSc are those that do not vary with respect to volume. Okay, so this is the total fixed cost. Following an activity-based costing study, fixed costs that do not vary as per the volume or any other cost driver has been identified to be 16 lakh per month. So initially company was thinking that 20 lakh is the fixed cost per month which is not going to change as per the number of units produced. But when we started doing the activity-based costing, so we divided the fixed cost, total fixed cost into multiple activities and we realized that 16 lakh this cannot be allocated to a respective activity, so this will remain fixed. But there is the rest of the 4 lakh can be divided into number of setups, and this is the additional information question is providing. The study revealed a milling machine is used to cut metal into steer support. Production of these steer support takes place in batches of 25 units. Okay, so there is a batch in the 25 units batch is being produced in one go, and these are 800 setups of such units which are there. So this is how they have kind of decided about their costing. Once a batch for children's cycle is finished, the next batch would be that for the adult cycle. So they are mixing a batch of children's cycle and then a batch of the adult cycle. Therefore, after each batch, there would be a setup change. So what are they doing? They are doing a setup change because now they have to move from children's cycle to the adult cycle. If 20,000 children's cycles have to be produced, number of setups required 20,000 steer support 25 per batch. This is 800 setups and the cost is actually over here. Like this 800 setups are there. In each setup we are manufacturing 25 cycles. So each setup is costing 500 rupees, comprising of material costs like change of oil, jig, etc. This cost was previously pooled together with fixed cost under traditional CVP. So that's the same thing which I just explained. That earlier we used to consider like 20 lakh is the fixed cost, but when we started doing the activity with base costing, we realized out of 20 lakh, 16 lakh is the fixed, while there is a setup which is running 800 times every month. And for each setup, when we are changing oils or we are doing some kind of maintenance, those things are costing 500 rupees for each change of setup. So this 4 lakh is a comprising of this. So this is the same thing which question has also explained. Now, let's move to the next part. It says like the plant manager would like to keep the number of setups minimum since they reduce the capacity of the machine. So as I mentioned earlier as well, if I am able to divide the activity on the basis of activity based costing, that these number of setups are 800. If I can reduce these number of setups, let us suppose instead of 25 units per batch, if I can somehow increase this to let us suppose 50 units per batch, then the number of setups will reduce to 400 automatically and my total cost will reduce because now for 400 setups my this 500 rupees cost will remain same. So instead of this 4 lakh, the fixed cost related to the setup change will become 2 lakh and the total fixed cost will be 18 lakhs, 16 plus 2 lakhs, not like the traditional costing. So in this kind of a setup, the plant manager he is thinking that what if we can increase the batch size or we can keep the setups minimum. I hope they are going hand in hand, so there is no confusion. The plant manager would like to keep the number of setups minimum since they reduce the capacity of the machine. Suppose that at any time the milling machine can be used to produce batches of either adult or children's cycles. He proposes to increase the batch size of children's peer support to 100 units in one batch. Now you see, earlier it was 25 per batch. Now they are saying 100. Plant manager is proposing 100 units in one batch. It means the number of setups will reduce from 800 20,000 units divided by 25 units to 200 now because I'm still producing 20,000 units because that is what the demand is, monthly production, right? And demand. So I'm not going beyond 20,000 units, but if I'm increasing the batch processing size. So instead of 25 units per batch, now I am producing 200, 100 units. The batch will reduce from 800 to 200. And if I'll be able to, as a plant manager, if I'll be able to do that, the cost, the fixed cost related to the setups, this activity based, will definitely change from 4 lakh to 1 lakh. Due to the larger batch production, additional inventory storage area would be required to store that will cost the company rupees 1 lakh rupees per month extra. So just imagine, even if this 1 lakh rupees per month extra cost is incurred, I'll be able to save 3 lakh rupees in my fixed cost. Because now, so 200 batches will be processed with 500, I'll end up incurring only 1000 rupees as cost for this, but 1 lakh rupees additional per month extra cost will be there. So instead of 20 lakhs, if I'll be able to make this change on the plant, it will cost me 16 lakhs plus 2 lakhs, which is 18 lakhs. Now you see these kind of discussions, they are very, very much practical in nature. What happens when you go to a factory and then you will realize that you are having a discussion with the plant managers. At time you will realize that they are always discussing about how to reduce the cost without impacting the quality, right? And these kind of discussions are pretty much obvious. They are always there. What if we will increase the batch size? Is there any other kind of a cost that we need to incur? Or like you see, if we are increasing the batch size, we need more inventory area. And these kind of cost benefit analysis, they keep on happening. So this activity based costing is always better than the traditional costing. Moving to the next part, the annual manufacturing capacity. So now we are discussing about the capacity. While the demand is 20,000 units for the children one, the capacity for CIL is currently 10 lakh cycles annually. The demand for cycles has been increasing within India. Obviously, the people are getting more health conscious, so they are buying more cycles. Hence, the management wants to increase the annual manufacturing capacity to 18 lakhs. So they are thinking from 10 lakhs, we will increase this to 18 lakh cycles. Increasing the capacity means bringing new machinery, purchasing new machineries, because then the additional production will be required and we need to invest in machineries or maybe in a better or a larger factory area as well. Let's see this 18 lakh capacity. Due to the increased production requirement, CL bought additional machinery. You see, same thing. So if we are increasing the number of cycles as a capacity of the factory, we need to have additional area and then we need to have additional machinery. All assets were purchased by account paid check. Below are the details of the plant and machinery. So this is what we have purchased. So question is saying that opening WDV for the plant and machinery on 1st April 23. This is the opening WDV which is 10 crore rupees. This is already there in the books. Now a new plant and machinery purchased and put to use on 30th of June. So we'll consider like 23 and 24 as the financial year for us. Remember this put to use in June, at the end of the June. So this is utilized, this was used in the production for 9 months. It is more than 180 days. So in those cases, the full depreciation is allowed in the income tax. Now the second machinery that they have purchased, they have put it on to use on 31st of December. And if that is the case, then in those cases, this machine is put to use for less than 180 days. And in that case, 50% of the depreciation will be allowed. Now, moving ahead, due to the increased production requirement, the need for storage space, both for raw material and finished goods, has increased manifold. Obviously, if we will be manufacturing, that's what I told you. If we want to increase the capacity, we will need additional machines and then we will need additional factory area as well for storage, for labor, and all those things. Right? So, extra space will be required. So, due to the increased production requirements, the need for storage space, both for raw materials and finished goods, has increased manifold. Storage cost at CIL's factory site that manufactures cycles is very expensive. Expensive. It happens generally because they are generally in the industrial area and all. And over there, I mean, area the kind of storage etc. is highly, it's very costly. So this is the same situation that this CIL company, which is our client, is also in the same kind of a situation. So they are saying the storage cost at CIL's factory site that is manufacturing cycle, it is very expensive. Expensive. Hence, the management wants to consider the option of implementing an effective just-in-time system for material procurement and production in order to reduce on the need for the additional storage area. Now you see that's also a good thought process. So what is happening actually? We are having brainstorming. The management is having brainstorming, and then they want your advice. They will need your consultancy. So they are just giving you some thoughts that this is what is in our mind. And that's what I told you, that at times company or the client will come up with a lot of solutions. So they are confused, not with the problem, but with the solutions that they have. So they may think about multiple solutions, and then as an advisor, as a consultant, they will approach you and will need your consultancy or advice on which one option or which one solution is the best solution from after doing a cost benefit analysis. So it's not only solving a problem, but at times doing the value addition, which makes us a better professional. So in this situation as well, management, they are considering JIT system. JIT system is basically just in time. So JIT, if you are manufacturing goods under JIT, it means the production happens against the demand. Okay, so it is not like that we are producing goods with an expected kind of a demand, we are putting it somewhere in the storage, or we need some additional material to be stored so that we are supplying it to the production. In the just in time kind of a method, whenever there is a demand, the production will happen, and when the production will happen, the inventory will be kind of procured and it will be directly used in the production. So in the JIT, what happens generally is that the company does not need a storage space. Okay, because it is just like procuring against the demand and then manufacturing it and supplying to the vendors and the customers directly. So management is of an opinion that in our factory, if we will increase the factory area to have the storage of these inventories and the finished goods, it will be very expensive. So instead of doing this storage cost expansion, the best thing is to implement the just in time kind of a system, whereby we'll procure only against the production and production will happen only against the demand. Okay, so that's what they are considering. Under the jet, the materials will be delivered directly to the machine on the shop floor. That's what I'm saying. It will directly be issued to the production without having a storage of the raw material. Also, JIT being a pull system initiated by the customer. It means the production happens when the demand is there. Okay. So once the cycle is manufactured, it will be sent out for delivery to the customers immediately. It means JIT will be able to save both your raw material storage space and your finished goods storage space. You don't need to store your raw material and you need not to store your finished goods. Okay. So that's why management is concerned or considering this JIT system. During the meeting, as a management accountant, you point out that this system needs to be sufficiently supported by an effective back flushing system that will account for components materials used in the production process. Now we need to understand what is this back flushing system. So in the just in time, I hope you understood, right? That what is happening. Just in time is a production will happen when the demand is there, and raw material procurement will directly happen to the production stage without storing it, right? So this is the JIT. In the backflashing system of JIT, what we do basically that instead of recording or making accounting entry at each level, like we have procured the goods and then we are purchasing or recording it in the books and then we are issuing it to the production so that issue entry will be there. I mean, at each stage, we need not to do the accounting. You see, cycle manufacturing may have uh, tens of I will say components, right, to manufacturing a cycle. So we don't want in the back flushing system. What happens? We don't do the accounting entries every time a material is transferred to production. Right? It is not like the real time accounting entries. Instead, what we do once the goods are finished. So the goods are in the JIT. The goods are produced against the demand, and once they are produced, they are completed. We book the all raw material at the standard cost basis. So we have a standard cost, let us suppose XYZ for a particular cycle. Once we will complete the production in the backflashing system, we will directly record that cost instead of recording the cost at each level, like purchasing raw materials or issuing it to production and all those things. So as an accountant, While the management is thinking that JIT can be a very good system because it will help us saving storage cost for both raw material and the finished goods. Same way, you are also suggesting the management that if we are going with the JIT, you want the back flushing system in the JIT to be work around. So you don't want to put accounting entries for each stage, but you are simply saying once the production will be complete, I will put a standard costing entry. Okay, so this is the suggestion you are giving to the management, saving a lot of time of yours. Given the large production volumes and fast turnaround times required under GIT, back pressing system is the ideal solution to account for the components. But you see, in this kind of a situation, the practical problem is that if you'll be booking the cost at the standard cost because you are not kind of regarding each issue to the productions and all. At times, what happens? The standard costing may differ from the actual costing that is happening because of the normal or the abnormal losses. Even in the standard costing, the normal loss is something that you have definitely covered up, but the abnormal loss is something that you need to book. So when you issue against the requisition, against the request, then you record all the abnormal losses as well. But in the backflashing, it doesn't happen. You have to book the cost and the standard costing. So that's a very big problem when you introduce backflashing. But it is very fast because you need not to make tens of entries. Rather, you can book it in one go. So I hope conceptually it is clear that what is your client, a kind of which direction they are thinking. So plant manager is thinking to increase the batch size so that under the activity based costing, the number of setups can be reduced in, and this will improve the total fixed cost, reduce the total fixed cost. While on the other side, the management is of the opinion that let's increase the capacity. So if they want to increase the capacity, they have purchased two machineries and put to them use on these days. Simultaneously, they are thinking JIT can be a very good model of inventory management because then we don't need storage at the raw material and at a finished goods level. You are the accountant and you are saying if you will introduce JIT, then you would like to do the accounting of the inventory and the back flushing system, which is recording once the total goods will be manufactured at a standard cost. Okay, I hope this is very practical. So again, I'm saying that these kind of situations they shouldn't be considered as a question. They are actually a practical kind of a problem that your client may come up if you will start working as a consultant. CIL has recently decided to start selling cycles to professional cyclists within India. So now they are doing professional cyclists within India. International exposure and increased availability of facilities has improved career prospects for professional cyclists. Yet at present, this market segment is at the nascent stage. The company is also foraying into this segment for the first time. CIL has opened a small dealership shop in Mumbai specifically to sell these high value professional cycles. Remember, these are professional cycles. The trend is increasing. So company wants to enter into the premium segment in the professional segment, and for this they have started a small dealership shop in the Mumbai. On March 31st, 24, which is the end of the year, they have imported its first batch of 100 professional cycles from a company in France. So they have imported 100 cycles from one of the manufacturers in the France. The details of the expenses incurred at the dealership in Mumbai are given below. So these are the expenses which are related to this particular import. Now they have cost of purchases which is 50 lakh. Remember 100 professionals. So there are handling fees of that the staff who's working. After sale warranty cost is 4 lakh. Import duties 2.5 lakh. Freight expenses 2.5 lakhs. Insurance of purchases 1 lakh. Arranging meetings or collaboration of buyers and sellers in the international kind of a market. So they are the intending agents. I mean, this commission is related to those people, the vendors over there, and from where you have purchased. So this is related to the buying of these cycles only. So if you're aware, I mean, there are few costs in this, like these salaries of accounting staff at the dealership, etc. They are not they are the expense of the company, but they are not the costs of goods sold. They are not the part of the cost of goods sold because They are the admin kind of expenses. So they'll definitely be an expense for the company, but they will be charged to the P&L rather than charging or making it as a part of the cost of the done. They have purchased, but they are not able to sell them. So all the 100 professional cycles that they have imported, they are in the stock as on March 31st, 24, which is the end of the. So they are currently being sold in the market 64,000. So what is this? This is the selling price. Okay, so this is the selling price. CIL also has a firm sales contract with a smaller cycle dealership for 30 cycles at 65,000 per unit. So currently they are selling in the market with 64,000 rupees, but out of this 100, they already have a sales contract with another dealership, and then the other dealership is agreed to buy 30 cycles out of 100 at 65,000, which cannot be settled yet. Okay, so this is not settled, but they have a sales contract. Estimated increment selling cost is 2000 rupees per unit for all the cycles. So what is happening? I mean, they are in the stock right now. The cycles are in the stock. But if I want to sell these cycles from their current state or the current situation or the location in the current state of operations they are in, then probably I'll not be able to gain that 2000 rupees from the market because those 2000 rupees are the additional expenses. So if I'll sell them right now from the shop that I have started or kind of a showroom in the Mumbai, so this Mumbai, they have started a dealership shop in Mumbai. Dealership shop in Mumbai, probably I'll not be able to fetch 65,000 rupees or 64,000 rupees because then I have to spend 2,000 rupees more to reach or to gain this 65 4,000 or 65,000. So if you can recall, the net realizable value for these kind of inventory, the inventory that I have will be this 64,000 rupees is the kind of final sale price. But if I want to marketing expenses or sales expenses, nobody would like to pay them. So the NRV will become 62,000 in this case and 63,000 in this case. And we can definitely compare it with the total cost of the inventory and we can see whether a write-off of inventory is required or not. Okay. The manager of the dealership for imported cycle is of an opinion that at the selling price of 64,000 per imported professional cycle, CIL will be unable to earn any profit margin at all. So they are thinking with this all the cost which is we just explained, the 64,000 is not something that the company will be able to make any profit. The same is true even with the firm order to 30 cycles for which the sale price is 65,000. So they are saying even if the annual appraisal depends on the profit that the dealership is generating. So she's saying this 64,000 or 65,000 is not making any sense, will not be able to generate profit on this amount. So she is willing to sell these cycles in 85,000 rupees. Hence, she is very insistent on increasing the selling price of the imported cycle. So she is just pushing the management to increase this particular selling price. Now you see, if you want to really increase the selling price, the customers can definitely pay premium if the cycles are really good, if the quality is really good. But that premium is also something the customer is generally ready to pay only if they are not having a alternate product of the same quality, right? Otherwise, they will get into the price comparison mode. And if let us suppose there is another company with a similar cycle they are selling, let us suppose in 65,000 or 70,000 even, you can never increase your cycle's price to 85,000 rupees. The 85,000 is something that you can fetch for these cycles only if some uniqueness is there or these kind of comparative products are not available in the market. That's very important that the product is premium quality, the quality is really good, and the alternate products or the competitive products are not available to compare the price. Otherwise, it will be very difficult for us to increase the price to 85,000 rupees. Or else, customer can pay for the premium or the quality, so this will become possible. So this is the complete question. This is the complete case study. So in this question, the client's name is CIL. They are into the manufacturing, right? So I'll just summarize, and I always humbly request that while you are attending these kind of case studies, it is always advisable to keep on making notes. It is never like, like in the examination center, you will not get enough time to read the case study again and again. So make the summary of the case study very carefully And if you really want to highlight something or underline something on the question paper, that is also advisable. So that all those key kind of parameters or attributes or facts that are given in the questions, you should be easily able to detect, right? So that's very important. So these are the traditional and the activity-based kind of a CVP analysis that the company has presented. They want again the batch to be increased so that the total fixed cost can reduce. Simultaneously, they want to increase the annual capacity from 10 lakh cycles to 18 lakh cycles, and for that they have purchased two cycles, two further machineries, and then they want to introduce a GIT system. And your accountant is saying that backcashing system in the GIT is that they want to prefer. Simultaneously, they have started professional cycles as well, selling professional cycles, and then they have started a dealership shop in Mumbai. And for that, they have ordered 100 cycles. This is the cost of those 100 cycles. And for these 100 cycles, they have an agreement on the closing of the year for 30 cycles only. While the 70 cycles they can sell in the open market at 64,000 rupees. But for this 65, 4 or 5 they want to fetch, they will be they need to incur 2,000 rupees additional cost. The manager of the dealership for imported cycle, right? So manager is thinking that 64,000 or 65,000 will not be able to fetch any profit. So she is proposing that the price should be around 85,000 rupees so that some profit can be made. This is the case study overall. Now we can slowly move to the questions and answers, which is the basically problems and the solutions that the company is having. So we'll see that these multiple choice questions. So let's go into the first question. So the company is asking, given the information about CIL's plant and machinery, the total amount of depreciation that can be claimed as per the Income Tax Act for the assessment year 24 and 25. The company does not opt for 115 BAA or 115 BAB. Okay. So to understand or to calculate the total depreciation, we need to see, which we have seen in this table, that the opening WDV is there. On this opening WDV, the total depreciation will be allowed for complete year. For the new plant and machinery, again the total depreciation will be allowed for full year because this is put to use for more than 180 days. The next plant and machinery which is purchased, it will not be kind of admissible for the 100% of the available depreciation, but because it is put to use for less than 180 days, right? So this will be only 50% of the available depreciation for this year. On top of it, there will be some additional benefits in terms of the depreciation, which the Income Tax Act provides, especially in these manufacturing kind of companies when the machinery is being purchased. So that additional depreciation will also be available for this second machinery for the full year, while the additional depreciation that will be admissible will only be for half, 50% for the second kind of a machinery. The remaining 50% on the second machinery can still be claimed in the next year. I hope we all have this understanding that when we are talking about the depreciation, generally depreciation is just like a deferment of initial expenditure into various years till the time the useful life of the company is there. So even if there is an additional depreciation which the Income Tax Act is allowing, that additional depreciation will be, it is just like a preponement of the depreciation that I was expecting to charge in the upcoming years. So it is just like I have preponed that depreciation and I am now allowed by the Income Tax Department to consider that additional depreciation as an expense. So let's do the calculation and the facts will remain same. I will take you to the solution of this particular case study so that we can quickly have the answer, the solution around it. So as I mentioned that the normal depreciation will be available on 10 crore rupees of WDB initial plus 5 crore rupees of the machinery, machinery which we have purchased and put to use for more than 180 days. So 15 crore rupees is the total, let us suppose, revenue which is available for the complete year. So on 15 crores, we will be able to fetch 15% of the depreciation. For the next 5 crores, this is the second machinery that we have purchased. Since it is put to use for less than 180 days, so we will have only 50% of 15%. It means 7.5% of the 5 crore. So this is the normal depreciation that we have, 2.6 to 50,000. But as I mentioned, the additional depreciation is also available in these kind of manufacturing setups. So the additional depreciation for the first machine that we have purchased, it will be available 100%. So 100% means the 20% that is allowed, we can claim 100% of that 20% because it is more than 180 days. For the second, this will be only 50% the way we have calculated the normal depreciation. So this will become 1 crore plus 50 lakhs, 1.5 crores, and this is 2.62 crores. So the answer for this particular depreciation will be 4.12 crores, which is over here option B. Remember, as I mentioned, the additional depreciation which is there for the second machine, so 50% additional depreciation, company can still claim this, but in the next year, next assessment year. For this assessment year, they will not be allowed to put this additional depreciation at 100% rate. So this is also a kind of a note which is given that as per the third proviso of the section 32, the balance additional depreciation being 50 lakhs, right, which is equivalent to this much, right? So this balance 50 lakh rupees can be still be claimed as deduction in the assessment year 25 and 26, provided CIL does not opt for the provisions of section 115 BBA. Okay, so this is the first multi-choice kind of a question. So again, these are multiple choice questions can be considered like your client is asking a maybe a question which can be answered in a very quick fashion. It is like a yes, no, or probably very quickly. So these are the multiple choice questions. Like a client is having a discussion, they are just asking that, what is that I can get? And then you can instantly kind of calculate and you can tell them. While a descriptive question is where a long discussion is required. Maybe you have to cover a lot of facts. You have to tell a lot of provisions of various acts, various concepts, and then you have to kind of summarize. So when we are addressing descriptive kind of questions, we have to kind of like understand the whole situation. In this solution, you can make three paragraphs. I generally recommend whenever a descriptive question is there, whereby you can in the first para you can explain the situation. So in the second para you can mention the relevant provisions, etc. That's what Act says. And in the third paragraph you can conclude on that on the basis of the situation and on the basis of the provisions that are available, this is the conclusion that you have drawn. So this is how you can draft the answers for descriptive questions as well. Moving to the second question. Second question says, determine in which of the following cases should the labor cost not to be factored into the cost of setup. So the question says that the labor cost, if there is a labor cost that we have incurred, it should not be taken to the cost of the setup. So, I mean, if we are obviously the labor is getting paid, so obviously that cost has to be there. But the point is basically there can be certain cases in which you can avoid taking that labor cost into the cost of the kind of an additional product or in the setup activity. And what can be those kind of situations when you have, let us suppose, already hired a labor. So there is a fixed cost which is already incurred for that labor. Now, whether that labor is sitting idle or whether that labor is working on something, obviously that will not make a difference. So if you are already utilizing the labor which is sitting idle, then there is no requirement to put that additional labor cost onto the product because you have just utilized the idle capacity which was kind of a sunk cost for you if you would not have utilized. So in this given situation, they are saying that in what cases in which following cases labor cost not to be factors. Remember, so the first option is cost of using temporary labor hired for particular setup. Now you remember, if you are hiring some temporary labor for a particular situation, then obviously that cost of that labor, because you have specifically hired for this particular setup, it has to be included in the cost of the setup. Second is basically which goes like cost of outsourcing setup activities. Again, it is a cash flow of the cost that is happening. So you are actually paying this to the outsourcing kind of a vendor. So that cost will also become a cost of your setup. Third is basically cost of using permanent labor. So there is a labor which is permanently available. It means a fixed salary is already there which you have to pay. And then they are sitting idle. So if they are sitting idle and then you ultimately have to pay them. So this is never a kind of a cost for your setup. So this should not be taken into account. The D is if additional labor supplies are unavailable in the short term and where no further overtime working is possible, cost of using permanent labor who are engaged in the production process. So they are saying that even if the permanent labor is there, right? But this permanent labor is already busy somewhere. So what are you doing? You are withdrawing that labor from somewhere and then you are utilizing in your cost in your setup. So that cost will also become a part of the setup because otherwise, if you have not used these resources, they were busy. So you have actually an opportunity cost which is sitting somewhere, right? So if there is an opportunity cost for those labors, obviously that will become a part of the cost of your setup. So out of these four options, the third option is the only option in which it goes and says that you have already a permanent labor is there and that is sitting idle. So this cost should not be taken into the cost of your setup. So in the C, we have this answer already. C, cost of using permanent labor who are otherwise idle. And if you go through the reason, even though for multiple choice questions, you need not to give them the reasons, but this is just for your understanding. So it is another benefit when you will start attempting these case studies from the digest, you will able to get these kind of reasons as well. It will enhance your understanding. It will give you better clarity on the concepts. So that's also very important. Now in the third multiple choice question, the question is which of the following is not a prerequisite for an effective GIT system? So what is GIT system? We explained in detail, just in time system. It means it is pulled by the customer. So when customer demands something, then the production starts. So if you really want to fit a GIT system in place, then what you need to have is the clear availability or visibility, I will say, of the customer demand. Because if the customer's demand is not there, which is visible, I mean, then it will become very difficult to implement the GIT system. Okay. So, so what are the prerequisites? Obviously, let's see. Lesser setup time is a prerequisite, right? Total quality management is a prerequisite. If you are not able to manage the quality, you will definitely be not able to put the GIT system in the place. Multi-skilled labor force, that's also a very big prerequisite for a GIT. If you really want to put the GIT in place, there are multi-skilled labors which has to be there. Okay. So it's like just to give you an example, maybe you can relate more. Like the McDonald is there. Okay, so McD, if a customer is goes to the McDonald's, what happens? Suddenly, this is kind of a GIT. So what are they doing? They are instantly manufacturing that burger when a customer demand is there. Okay. The moment they are manufacturing, they are kind of preparing that burger for the customer. It means customer is pulling that demand. So what is happening if GIT is there in that kind of a mechanism, the labor force has to be very skilled. So whatever the resources that the McD franchise is having, they are multi-skilled. So they know how to prepare burgers as well. Then they know how to take the orders as well, how to collect the payments as well, how to make coffees as well. So they are kind of having a multi-skilled labor kind of a dynamics. So if suddenly, let us suppose over weekends or in the evening, the demand is increasing, they are not kind of struggling with the skilled labors. So they are training all those skills labors with respective skills to fulfill because this is the kind of a JIT system. Okay, just in time. But what happens? A very big problem is where the varying demand patterns are there. Okay, so in implementing a JIT is very difficult if you can't predict the demand. Okay, so the multiple choice question for the third option is varying demand patterns. So to implement an effective JIT, you have to have the good visibility on the client demand. Okay. D, the next one is says that which of the following is not a problem of using back flushing in GIT system. So I told you what is back flushing in GIT system, whereby you are not recording the issue of inventory to various stages. Okay, while you are not doing or making the multiple entries at this stage, what are you doing is actually you are directly booking the standard cost once the goods are produced and they are finalized. Okay, so they are saying what is not a problem. The first option is the production reporting has to be very accurate, right? If the production reporting is not there, or it is not correct, not inaccurate, not accurate, what will happen? The backflashing will not work. If the production is not accurate, you may end up charging extra, additional, or a lower standard costing. So you have to have the production reporting accurate. The scrap reporting has to be very accurate, otherwise you will charge the standard costing on the total production, and then this will also become a difference between the actual costing and the standard costing. So this has to be also very accurate. Third says, unless the software allows picking and backflashing system to coexist, tracing is not possible. Yes, so you have to invest in the systems as well. They both have to work hand in hand, picking and backflashing. So whatever inventory you are getting picked, it is getting picked. It has to be auto recorded by the backflashing system once the complete production is happening. So backflushing in JIT can only happen when the production reporting is accurate, scrap reporting is accurate, and these systems are working together. Last option is saying backflushing requires no data entry of any kind until a finished product is completed. So this is true, right? So this is not a problem. This is absolutely true that the backflashing will only do the accounting entry when the goods are produced, and that's a very big a kind of like situational challenge that we have, because in this case what we need to do is we are going to charge a standard cost which can be different than the actual cost. So this is not a problem. Even in fact, this is an advantage of using backprocessing in the jet environment. Fifth question says, which of the following factors will make the customer more sensitive towards the price of the professional imported cycle? Remember what happened? The company is entering into a professional cycle, imported cycle segment, and the manager of the store or your dealership shop, she is of an opinion that the price should increase to 85,000 instead of 64,000 and 65,000. The question has also given you the reason for this by saying that the performance appraisal of the manager, it is dependent on the profit of that particular store. So she is really willing to earn some good amount of profit. Again, if you are trying to do that, in what situations or circumstances you are thinking that customer will be ready to pay you higher. So you have to pick which of the following factors will make the customer more sensitive towards the price of the professional imported cycle. More sensitive means they will be hesitant in making the payment, right? So the first one is higher perceived quality of the cycle. If the customer will think that the quality of the cycle is really high, then customer will be ready to pay. So this will not make them sensitive towards the price. If the quality is good, as I mentioned, if the quality of the product is good and the customer does not have an alternate competitive kind of a product whereby the prices can be compared, the client or the customer will keep on paying. They because they will convince themselves that the product quality is really high. Okay, so the first answer is higher perceived quality. It is not a sensitive area towards the price for the customer. The second is practical difficulty in comparison of the important professional cycle with any alternate available. So I did mention this as well, that if there is no imported product is available as an alternate, then also customer will not be bothered about the price because they can't compare. So they don't know whether the 85,000 is the correct price or 1,05,000 is the correct price. Third is imported professional cycles being unique. You see, again, if they are unique in case and the customer cannot have access to them from any other vendor, obviously the customer may convince this that the quality of the products are higher, or they will start paying for the uniqueness. So these all three options, they are not the price sensitive. Customer will never be concerned about the price in these three initial answers. The fourth one is the high proportion of expenditure product cost to the customer income. So this fourth is basically if we are putting this, so we need to understand our customer And even though we are entering into the professional segment, they must be the high income group, but we are still have to be very sensitive about the portion, the cost of the cycle that we are introducing to the total customer's income. So the proportion that they have. If as a customer, let us suppose I am earning 100 rupees and then I have allocated that I will only spend 10% or 20% of my earning to a particular cycle, then my 20% is equivalent to 20 rupees. I will be very price sensitive if there will be a product which is available to me which is beyond 20 rupees, right? So I will restrict myself to buy any cycle which is more than 20 rupees. So that's a sensitivity, price sensitivity. So if we will have high proportion of expenditure to the customer income, this will make customer price sensitive and then they may avoid that cycle. So if we want to sell this to in 85,000 rupees, what we need to do is to understand the customer income, their buying capacity, the segment, the customer segment that we are targeting in this case. So in the fifth multiple choice, the answer is high proportion of expenditure to the customer income, because this is the only criteria or an option which will make my customer more sensitive towards the price. So the answer for the fifth is D. Okay. Now we are moving to the descriptive question. The first question in the descriptive question is find the break-even point per month and profit per month under the traditional. So you see, as I told you, if the 25 units per batch is there, it means that 4 lakh is just being divided into 800 and uh, 500. So 800 setups are there and 500 rupees per cost setup is there. So as 20 lakhs in traditional and activity based both costing, the profit will remain same, right? Even if I want to do the analysis separately. The only benefit can be if I and I can change the setup as suggested by our plant manager. They want to increase the batch size from 25 to 100, reducing this particular cost. Then there will be some visible benefits that I discussed while reading the question itself, case study itself. But now the question is answered. Remember, in the first instance, the total profit will remain same. So how to do that basically? So they are saying we need to calculate the contribution, which is the sales minus the variable cost. So in this kind of a first situation in the traditional, just a minute, yes. So in the traditional CBB analysis, the answer is that selling price is 16,000, variable cost is 15,000. So I am making a contribution per unit is 1,000, which is 16,000 minus 15,000, right? My fixed cost per month is 20 lakhs. So what I need to do is to at least sell my per month unit. If I'll sell 2,000 units, then only I'll be able to recover this fixed cost. So this, how do you got this 2,000? It is 20 lakh divided by 1,000. So this 2,000 is my break even. If I'll sell below 2,000 units, then I will have a loss, and the loss will incur because of the fixed cost that is there. And if I'll be able to sell more than 2,000, then it will be a situation of profit for me, because at 2,000 I'll be able to recover the whole cost. So each unit I'll be selling, right, will bring 1,000 rupees for me as a profit. After, so after 2,000 units, if there is even a one unit I am selling, that will give me 1,000 rupees of a profit. And we are selling 20,000, so it means 18,000 extra units are being sold. And as I told you, 18,000 extra units are sold, and then each unit is giving me 1,000 rupees as a contribution. So 18,000 into 1,000. That's another way, basically, right, to do that. So, but there is another way, right, through which the question is solving this. It says like monthly demand we have 20,000 multiplied by 1,000 is 2 crores, right? Is the total contribution minus fixed cost of 20 lakhs. So total contribution minus fixed cost is 1 crore 80 lakhs. So this is one way. The other way is basically that at 2,000 I was just able to do the break even. So if I'm selling 20,000 units, 18,000 extra units are being sold after recovering my fixed cost. So 18,000 multiplied by 1,000 is 1 crore 80 lakhs. So I mean, whatever way you want to calculate, it's your choice, but the answer is 1 crore 80 lakhs. In the traditional, this answer is there. As I told you, because the batch size and setup cost is same, which is 4 lakhs. So the answer Even in the activity-based CVP method, the profit will remain per month same. You can see clearly that it is 1 crore 80 lakhs in both the answers. So in the second activity-based costing, it is like contribution is same. It is just like the activity-based method says that it is 16 lakh rupees of the total fixed cost that we have. So break even per unit will be, so what I need to do is to calculate this from the 16 lakh perspective plus the number of setups. So activity based costing says you have the total fixed cost will be the fixed cost which you cannot allocate to an activity plus the activity based costing. So my 16 lakh plus 800 into 500, this is the setup cost. So the total fixed cost will become 20 lakhs only. And here, that's why the total profit is same. Otherwise, if I can reduce the batch size, the total fixed cost will reduce. I hope the question is asking for that as well. Maybe in the second option, you will clearly see that. So monthly demand units is 20,000 again. So this is more or less like the same thing. Okay, because this 800 into 500 is same for both the situations. The second option in the question says analyze the impact on BEP break-even point units per month and profit per month when the batch size will increase. This is also what we discussed that if from 25 units to 100 units we will do it. It is just like from 4 lakh rupees of activity based costing, it will reduce to 1 lakh rupees, right? Because the batch size will reduce, but the company has to incur extra cost storage. If you can recall, there is another extra 1 lakh rupees of a cost that is there. So the net benefit that the company will get that the reduction of 3 lakh rupees in the cost, but 1 lakh additional cost will be there. So net benefit will be 2 lakh rupees. It means the profit that we have just calculated 1 crore 80 lakhs, it will increase to 1 crore 82 lakhs. Okay, but we'll see how the calculation has been done. But I have just given you a kind of a overview that why it is happening. So in the same situation, 16,000 minus 15,000, I'm earning per unit 1 crore 1,000 rupees. Fixed cost per month per activity based model, it is 17 lakhs. How? 16 lakh plus 200 into, so 16 lakhs plus 1 lakh, that extra cost that was there 17 lakh plus 200 setups will be there with 500 rupees per setup. So 17 lakh plus 1 lakh is 18 lakhs. So you see, you can clearly see earlier the fixed cost was 20 lakhs, right? It was 20 lakhs. Now it is 18 lakhs. So this will add to 2 lakh rupees in the profit. That's a simple kind of a calculation. Okay. Analysis is the same that we just discussed. The third part of the question says, explain. I mean, I'll read it through, but the answer is very simple. The answer is already what we have discussed. Let's go through and again, I'm reiterating after your response. So you see, the answer is setups. They reduce the production utility of a machine. A lower number of setups or lower setup time can improve the utilization of the machine, right? I mean, it is like when these Samsung and all they launched these flip phones, right? You see, this flip comes with a life, so it is like how many times you can do this flip, open and close. In the same manner, every machine comes with a kind of a setup. That how many setups this machine is designed for. Okay, this is known as maybe the standard life of that particular product machine. So this also gives the company flexibility to keep changing the batches produced at the milling machine to cater to children's cycle and adult cycle. If you can recall, they used to have this children's cycle and then adult cycle as a kind of an alternate to processing. The other factors that impacts flexibility of the production would be the setup cost. The lower the setup cost, the higher the flexibility to change its batches produced at the milling machine to cater to each type of the cycle. Simple. Okay. So this is how you draft the answers to this. The next question about this particular case study is evaluate which of the costs pertaining to the 100 imported cycles are allowed to be included in the cost of the inventory in the books of the CIL. So any cost that you are incurring to bring those goods to India, to let us suppose your factory, all those costs will be included. but the cost that you are incurring to sell that inventory will never be a part of that costing, right? This is as per AS2. So there are a lot of costs which are given, and then the question is saying that you need to calculate the costing. So you see all this which is there: cost of purchase, handling cost. I told you salaries of accounting staff at the dealership. This will not be there. Sales commission to sales agents. It will not be there because this is a selling expense. So salaries or selling expense, they will not be there. But yes, brokerage or commission, that is your pay to indenting, which I told you, indenting agents are the agents who are making the arrangements or corroborating between the international traders. I mean, one side vendor is there, the other side purchaser is there, seller and purchasers are there. So that is basically because without their commission, this purchase wouldn't have been possible. So it will become a part of the costing itself. Okay. So import duties are there, freight expenses are there, insurance of purchases. Yes, at times what happens, we are importing goods. So the insurance that we are doing is maybe the insurance which is, let us suppose the import of goods are happening through ocean. So it may be the insurance that I have paid for the stock in transit, right? So that can also be a part. So over here, as per the IND AS2, the following costs pertaining to the 100 imported cycles are includable in the cost of the inventory of the books of the CIL. So cost of purchase, handling cost relating to imports, import duty, freight expense, insurance of purchase, brokerage commission for intending deals. So this all will be a part. Now you see this is 63 lakhs. Okay. So all this 63 lakhs is there for 100 cycles. It means if you see the cost of the inventory, it is 63,000 per cycle because this 63 lakh is for 100 imported cycles. And that too, you need to spend some more expenses, which is the selling, etc., to sell these cycles. So when the manager is saying that if you are selling this in 64, 65,000 rupees, you are not going to make any profit, she is right in that particular sense. So salaries of accounts department, sales commission, and after sale warranty cost, because they all are selling expenses. Okay, they are not to be included in the cost of inventory. Therefore, they are not allowed by the Ind AS 2 for inclusion in the cost of the inventory and are expensed off in the profit and loss account. Remember, they are not allowed to be the cost of the inventory does not mean they are not allowed or eligible for the expenses. It is just like they will not be routed through trading account, but they will be routed through P&L account. But if you're trying to calculate the net profit, they will be there in the profit and loss account, right? Maybe they will not be a part of the gross profit calculation, but they will always be there a part of the net profit calculation. Okay, because in the trading account we don't take purchases, we take cost of goods sold, and we are comparing it with the sales to calculate the gross profit. Remember this. Okay, so any expenses which are not related to the inventory, they will be taken to the P&L account, and then they will be considered while calculating the net profit. Okay, yeah, so we were going through the seventh question, and we are on the second part now. It says that calculate the NRV of the inventory of CIL relating to these 100 imported cycles. Okay, so NRV means net realizable value, which I told you that what we need to do is basically we need to calculate the market price, and then we need to reduce the selling expenditures which will be incurring. So I have some goods which are available in my factory. What I need to see is if I am going to sell these goods as in the condition they are in, from the location they are in, then how much money I can fetch. Then let us suppose if I have to incur 2000 rupees more to sell them from a showroom, those 2000 is the extra cost. So if I can sell from that showroom those goods is at 65,000 rupees, then from the factory, if I'll be selling them, I can only fetch from the market 63,000 rupees. Okay, because the market will say that why should we pay for the selling expenses if I'm directly purchasing them from your factory. Okay, so that is the net realizable value, NRV, and cost we have already calculated. So we'll see the cost and then we will calculate the NRV, and whichever is lower is what we need to record in the books. Remember, so that will be the third kind of a part of the question, that how much is to be recognized. In the second, we need to calculate the NRV. Remember, in the question, we have out of 100 units, we have already sold 30 units in 65,000, while the remaining 70 units can only fetch 64,000 from the market. Okay, but to fetch the 64,000 or 65,000, I need to incur 2,000 rupees more. So for these 30 cycles, my NRV, net realizable value, will be 65,000 minus 2,000 is 63,000, and for the 70 remaining cycles, it will be 64,000 minus 2,000, 62,000. So my NRV for the total 100 cycles will be 30 multiplied by 63,000 and 70 multiplied by 62,000. That will be my total NRV of the inventory that I am holding. So if you see the calculation, so calculation of NRV of the inventory of CIL relating to these 100 imported cycles. While performing the NRV test, the NRV of 30 cycles to be sold to the other cycle dealership under a firm contract will be 63,000, as I mentioned, 65 minus 2,000. The cost of inventory per cycle as calculated in 1 above is 63,000. So therefore no adjustment is required because cost or NRV both are same. But the NRV of the remaining 70 cycle is 62,000. So NRV is 62 while the costing is 63,000, right? So I have to reduce my inventory to 62,000 rupees for at least these 70 cycles. So 70 cycles, 62,000. This will be the NRV. Now, so my total inventories NRV is very simple. So 70,000 multiplied by 62,000 and sorry, 70 cycles multiplied by 62,000 and 30 cycles multiplied by 63,000. This will be the total NRV. The last portion of the question says calculate the value of inventory of 100 imported cycles as of March 31st, 24. Calculate the value of inventory of the 100 imported cycles. So very simple. This is what we have already done, that 63 multiplied by 30, 62 multiplied by 70. And then we need to compare this with the 63 lakhs. The cost of inventory per cycle is calculated above 63,000 per cycle for 30 cycles. Therefore, 70 cycles have to be valued at 62,000, whichever is lower, right? Therefore, CIL has to write down. So what will happen? For 70 cycles, we have to reduce 1,000 rupees from the books, right? Because the NRV is only 62,000. So 1,000 rupees is the additional value that we have already carrying in our books of this inventory. If I'll sell this inventory today, the company will not be able to fetch 63,000 rupees. For 70 cycles, they will only be able to fetch 62,000 rupees. So on 70 cycles, I have 1,000 rupees of overvalue of the stock. So 70 multiplied by 1,000 per cycle, 70,000 rupees is the reduction in the inventory that will happen. So I will reduce my inventory with 70,000 rupees and I will take this to the expenditure. Okay, this is how you write down the value of the inventory. You see, so value of 30 cycle is 63,000 this much, value of 70 cycle 62 is this much. Total inventory value is 62 30,000, while 63 lakh is the total cost that we are sitting at. So we will reduce this 63 lakh to 62 30,000. This will be the reduction in the inventory, and then you can pass the account inventory purpose. Okay, to reduce the inventory. Okay, I think very good case study. It helped you understanding certain requirements. So you see, this question was able to give you some insights around JIT, which is just in time. It was able to explain the concepts of traditional CVP and the activity based CVP. Okay. I mean, very fantastically, the question has explained all the situations and asked you to do traditional and activity based cost analysis. It has given you some insights around the just-in-time method and what is the backflashing in the just-in-time, which is very important. It has given you some more insights about the increase in the capacity and the treatment of the depreciation when you are purchasing new plant and machinery and putting it to use for more than or less than 180 days. This question has also given you some more insights about the import of cycles and the expenses that will be taken to the P&L account and the expenses that will become the part of the costing. It has also given you more insights about how you can sell the products which you are importing at a higher price. What what will make customer as a price sensitive. Right? So that's also a very important kind of a concept. Simultaneously, it has also given you insights around the NRV calculations and how the impact of the cost and NRV is being considered, taken care in the books, right? So overall, I mean, it was a really very good kind of a case study, and it has given us more insights about the practical world of a manufacturing company. So with this, we have come to an end of our first case study for today's session, and we may now have 15-20 minutes of a break, and we can come back by quarter past 8, which is sawa 8 baje. So we can come back to that time, and then we will go through with our second case study for the day. Okay. So thanks a lot, everyone. I'll see you in 15-20 minutes. Team, we can announce a break for the time being. Thank you. Okay, I'm sharing my screen. Welcome back, everyone. I hope my screen is visible now. Okay, so now we are starting with the second case study for today's session. Second case study that we are presenting today is about ABCD Limited, which is a textile manufacturing company. Okay, so let's see that what is your client has come up as a problem with, and then what are the solutions that they might have, and what level of validation that as a chartered accountant you can do, right? So let's discuss about this particular case study. Again, in the previous case study, it was manufacturing, and then there was some JIT and all those things that we explained. In this particular case study, we will learn a lot of concepts, including some concepts from auditing as a background as well. So be attentive. It's a very important case study. ABCD Limited is a textile manufacturing company which is based in Surat, Gujarat, which enjoys a vintage of more than 50 years of good reputation and business. Okay, so this is a kind of a old company with 50 years of legacy. The company was set up by Mr. Amar Dev in the 60s in a small room, and as years passed by, it became such a successful and big business that now, after serving domestic consumers, the company has gone global and expanding its business across Europe and Canada through third-party sales from India. Now you see, the background is that this is 50 years old company, ABCD Limited, based out of Gujarat, and the company, they started from a small room, but now they are not only into the domestic consumers, but they have gone into global markets as well. But to reach out to the global markets, they have some mediocres in between, which are known as the third party. The global markets that they have been a part of, they are Europe and Canada. Third parties, sales from India. Now Mr. Rahul Dev. So this is the third generation. Rahul Dev is the grandson of Mr. Amar Dev. Mr. Amar Dev started this company in 60s. Okay. So he's the kind of a grandson of Mr. Amar Dev. Now he is the managing director of the company, Mr. Rahul, and has been following quite an aggressive approach in globalizing their business after graduating from college. So Rahul is pretty much aggressive with globalization. So he just wants to expand his business across globe. Okay, so he is doing that. He remains in constant touch with CA Nitin Garg, partner Nitin Garg and Company, Chartered Accountants, and keeps on discussing with him legal compliances and procedures. Okay, so that's a simple background, very simple background. Rahul is the managing director for our company and he wants to expand globally. Right now, they are already having presence in Europe and Canada, but there are third parties who are involved in between. Let us consider Rahul is a friend of CA Nitin and CA Nitin is a partner with Nitin Garg and Company. So CA Nitin and Rahul they keep on discussing about how ABCD Limited can expand their operations to different countries over globe. Okay, that's a background. So let's see that what is that Rahul needs advices or consultancy from CA Nitin. The next thing is Rahul knows that the complexities in the businesses have increased a lot, particularly after advent of GST, and it is imperative to diversify the ever expanding businesses. Okay, so Rahul has that at least understanding that GST is impacting their business. He understands that their company is well integrated into the web of international business transactions. There is inward as well as outward flow of goods and services between India and other countries. Okay. GST impacts import and exports too. So Rahul has that kind of an understanding because he's already into business. He has seen a lot of imports and exports, and then he's friend with CA Nitin as well. So he already has a consultant which he has onboarded. Provisions in the GST law seek to, first is, provide a level playing field to domestic suppliers vis-a-vis international suppliers in case of imports. The GST is basically why GST is important because when you are importing some goods, what are they doing by putting GST on the imports and all? They are actually making the domestic suppliers, international suppliers, and domestic suppliers their playing field. They are levelizing it by GST. So they are utilizing the GST in such a manner that the domestic suppliers will not suffer by international supplies. In the same manner, this is the import case. In the same manner, when the domestic manufacturers, they are exporting goods, then GST is also made in such a way that it is facilitating those exports and creating a international leveling field for the domestic suppliers. Now, so one side they are providing a level playing field for the importers, and they are making exports more competitive in the same manner. He has been discussing various provisions of GST laws as will be applicable on import and export supplies with respect to their business. So Rahul is continuously discussing, taking consultancy from Nitin on various matters of his business. Okay. Now ABCD Limited wants to expand its business and management has found a suitable site which meets its requirement. So the company is expanding and then they have a area, a site which is meeting the requirement. The said site is owned by one of the directors of the company. So the site which the company is planning to purchase, let us suppose, that is which is suitable for the company's requirements is owned by one of the directors, which is known as Mr. D. However, Mr. D was unwilling to sell his prized property to the company. So ABCD approached Mr. D to purchase the property, but Mr. D is unwilling, so he is not ready to sell the property. The company, however, offers him in exchange a bigger site located in an area having commercial potential. So company, instead of making the payment, they have offered him another site which have some commercial potential. Lured by offer, Mr. D agrees to the above. So Mr. D is now agreeing that he will exchange his already existing site with a commercial potential site. A property valuer who is a civil engineer by profession, who is having experience of 20 years in valuing properties for commercial banks, is also approached by a company for arriving at value of asset involved in the above deal. The valuer does not possess any other registration or accreditation. So since it is a kind of a barter transaction whereby one property is exchanged with another property, the company has to kind of value that particular land that they are giving and the land they are getting in exchange. They have appointed a property valuer. So this person is a civil engineer and they are having an experience of 20 years doing the valuation for commercial banks. But there is no other kind of a degree or an association that this valuer is having. Okay, which can be a challenge as per the company side. So we'll discuss this at a later stage. Now, so this is one part whereby a side exchange is happening with one of the directors. Now the next part is Rahul, in order to expand his business, also discussed with Nitin on setting up a subsidiary outside India. So Rahul is playing little smart. You see, in Europe and Canada, the ABCD Limited has expanded the business, but there were third parties who were involved. Now Rahul is thinking of starting a subsidiary, setting up a subsidiary outside India at Paris for specifically carrying out the import-export transactions easily. And soon afterward, Rahul sets up a subsidiary at Paris under the name and style of PQRS Limited. So now you see ABCD Limited is already there. Now they have a subsidiary in PQRS Limited known as PQRS Limited in Paris. So Rahul is able to set up this particular subsidiary. ABCD Limited is engaged in the business of manufacturing clothes for other textile companies and non-textile companies as well. So ABCD is, it's not like that they are into the B2C as a segment only, business to customer, but it apparently seems like they are into the business to business segment as well, B2B segment as well, where they are manufacturing clothes for other textile companies. So this is known as B2B, which is business to business. If they would have been doing this only for the customers, direct customers, then they would have been part of the B2C business. But by like apparently it seems like this PQRS Limited, which is opened in the Paris, in the France, it seems like they are there. This particular subsidiary is there for B2C. Apparently it seems, while ABCD is already into B2B business. Now the company will be itself carrying out the import and export transactions without involving any third party, which was initially At the beginning of the question, it was mentioned that they have third parties through which they are making sales to Europe and Canada. Now, company is thinking they will not involve third parties and then they will do it by their own. And to do that, they applied an IEC, which is Importers Exporters Code online and gets the same. So they applied IEC, which is the IC code, and then they got the same. Its wholly owned subsidiary PQRS Limited, remember, which is in France, is engaged in business of ready-made designer garments. Okay, so they are doing ready-made designer garments business in the France. The subsidiary purchases garments and other stuff from its parent companies. It means there is a direct export which is happening from India to France, from ABCD Limited to PQRS Limited. The demand for garments of PQRS Limited is very high, and hence to cater to its shortfall, PQRS Limited also purchases garments from other companies. So the company in the France, PQRS Limited, their products demand is very high over there, and at times the import that they are doing from ABCD Limited is not sufficient to cater to that transaction. So PQRS has to buy it from other companies in France as well to cater to that shortfall. Purchases are made at competitive price. During the year 23-24, ABCD Limited sold garments to PQRS Limited for Euro 13 lakhs on 1st January. The cost of these garments was 936 lakhs in the books of ABCD Limited at the time of sale. At the year end 31st March 24, after 3 months, so they sold on 1st January, but after 3 months, all these garments they are still lying as the closing stock with the PQRS Limited. Euro is the functional currency for PQRS, while Indian rupees is the functional currency for ABCD Limited. Okay, so ABCD Limited sold some goods, which is the costing is 936 lakhs, but they are still in the stock of PQRS Limited. So PQRS Limited is not able to sell them. The purchase price for PQRS Limited is 13 lakhs. Okay, euros. You see, in this question, transfer pricing can also be there. Okay, we will see, like how things are moving, but yes, that can also be affected in this case. At the year end, 31st March, okay, perfect. Now, there are a couple of instances or couple of situations which are a kind of Rahul might be interested in taking advice from Nitin as a chartered accountant. Okay, so let's see what are the various aspects. ABCD Limited seeks help from CA Nitin on the following issues. So there are a couple of issues. During the year, the first issue is during the year, Rahul is finding it difficult to comprehend the GST taxation with respect to export sales made by the company ABCD Limited, which are of a particular nature. So Rahul is facing a challenge. So he is not able to understand how GST will work in case of a specific transaction, which is very peculiar in nature. So what happened in that transaction? One such sale is where ABCD Limited received an order to supply goods to a dealer B in Greece. So there is a dealer quoting it to be. What they did, they actually and then they asked that Singapore supplier to directly to ask him to supply goods to B in Greece directly. Two invoices are raised here. One by a company on B in Greece. So company what company has done? Company has created a invoice for B in Greece with let us suppose X amount, and the other is by C in Singapore on ABCD. So Singapore company has raised an invoice to company ABCD Limited for selling goods. So even though the transaction is like the Singapore supplier has directly supplied goods to the B in Greece, which is our buyer, but the invoicing has happened that the dealer B has been invoiced by the company from India, and then the Singapore company has billed to ABCD Limited in India. I mean, these are very, I'll say, frequent such transactions. The nature of transactions in the international market is pretty much frequent. So this is not like a new or a peculiar situation. This is very common in the international transactions. And this is obviously advisable as well because if C will directly bill to the B, then he might get the contact. contact numbers, email IDs, and all, and this can put ABCD Limited into risk. So it is never advisable that C will bill directly to the B. Otherwise, ABCD Limited may lose some business. Okay. The point to be noted here is that goods do not touch the Indian shores. They are shipped by sea from Singapore to B in Greece directly. There are many more such kind of export sales, and Rahul seeks CA meetings help in getting out the confusion. So these are kind of tri-party transactions in the international market where three parties are involved. And in these kind of situations, how GST framework will work, this is what Rahul wants to understand from CA meeting. That is first situation. Moving to the second situation, Rahul seeks CA Nitin's opinion on the GST procedures and treatment for the following two types of export transactions which he plans to proceed with in near future. So there are some transactions which Rahul is thinking of conducting, and then he is asking Nitin's opinion on this. The first transaction is Rahul has purchased a license to put up a stall in the textile supermarket Global fair to be held at Milan, Italy, and he wishes to send his team to this fair along with their company's merchandise to display over there for promotional purposes. Okay, so in the Milan, Italy, there is a fashion fair, which is a global fair, which is happening in the Milan, Italy, and his wishes, he is planning to send his team to this fair along with their company's merchandise to be displayed over there for promotional purposes. He had heard from a dear friend that he could sell his company's products within India, but these could still be categorized as export. He was eager to know about such circumstances. So in the first situation, while Rahul is seeking a consultancy from Nitin on a tri-party transaction in the international market, in the second situation, Rahul is also wants to understand what will happen if he is sending his team along with some merchandise to in Milan, Italy for a fashion. So they will be promotional purposes for the display purposes. And simultaneously, he is also interested in knowing if there is any situation in which he can sell goods in India, but they can still be categorized as exports. The next situation is there is another situation whereby the chief accountant of the company further seeks CA Nitin's time to understand about the valuation and taxability of the following transactions under GST. So now the chief accountant is there. It's not only Rahul, a chief accountant also wants to understand something. Now ABCD Limited has imported a special fabric from Paris and files an ex bond bill of entry for clearing such warehouse goods for home consumption. Okay. Now you see ex bond means bill means that the goods that were imported were put in a warehouse, a bonded warehouse. So while doing this, the duty was not due, right? But when you are doing this ex bond consumption, it means now you are releasing those goods for home consumption and GST will be applicable at that stage. Okay. So ABCD Limited imported textile fabric from London and sells them to the Panica Private Limited in India itself before the goods are cleared for home consumption. So this is the one stage where export bill is filed for clearing the goods from warehouse. Second is basically that ABCD Limited without filing any, they imported the goods, but before the goods are cleared for home consumption, they sold it to another company, which is Panacea Limited. The custom declaration, that is bill of entry, etc., is filed by the agent of Panacea. So it is like that before the home consumption, they sold these goods to Panacea Private Limited for clearance of such goods. Okay, so this is another situation. I mean, there are multiple situations that are there, and the question is definitely giving you a lot of insights. And I'm 100% sure that all these will be uh, a kind of drafted as a questions, whether multiple choice or descriptive, and then they will definitely ask your opinion on such situations, right? The another situation that the question is explaining is about the audit. So the question is saying that the statutory audit of the company ABCD Limited is also being carried out by Nitin Garg and Company. So Nitin is his friend, and the statutory audit of the ABCD Limited is also taken care by Nitin Garg and company under the supervision of the engagement partner CA Krit Garg. So it is not Nitin is not the engagement partner, but CA Krit Garg is there, the engagement partner. CA Krit understands that as the auditor, he should develop an audit plan that should include a description of the procedures to be performed as per SA 315 and 330. So CA Krit, he has an understanding that he needs to draft an audit plan whereby he'll be writing that what are the risks that he has identified and then what are the various audit procedures that he will be performing to mitigate the risk which is there. So an audit plan has to be drafted. Okay. The audit plan is more detailed planned than the overall audit strategy, right? So first of all, as an auditor, we need to create an audit strategy. This audit strategy generally includes the nature, timing, and extent. Now, when we are talking about the nature, so nature says that what will be the nature of the procedures that we will be performing, whether control testing will happen, whether substantive testing will happen, whether you will do TODs or you will do inquiries, observations, reperformance, recalculations, what is exactly you will be doing, or you will perform analytical procedures, or you will do test of details. I mean, that all is the nature. So in the overall audit strategy, you need to mention that what will be the nature of such audit procedures. Simultaneously, you also need to mention about the timing. So nature, I explained what is the meaning of the nature in these situations. Timing simply means that whether you will be doing at what time. So is it like any interim audit will also happen? Like let us suppose for 9 months, for 10 months you want to perform the audit and then you want to roll it forward for the remaining 2 months, 3 months, generally 9 months of interim testing is happening and then you want to roll it forward at the year end. So that timing is very important. When will you do what? And the extent of the audit procedures. So what will be the extent? It means the volume. Basically, nature is what type of procedures, extent means how much procedures will be performed and when they will be performed. So that is known as NTE in the audit. So if somebody is asking what is the NTE, that is nature, timing and extent. So the audit plan is more detailed than the overall audit strategy, right? Which is the NTE of audit procedures to be performed by engagement team members. Planning for these audit procedures takes place over the course of the audit as the audit plan for the engagement develops. So whatever audit plan you have made, it will have a detailed kind of a description of the audit procedures. Just to give an example, if you have written down like cash in bank, then it will show that what are the assertions that you are going to address. What are the assertions that you have taken as a risk and then for each risk that is associated with those assertions, what is the procedures that you have drafted to perform in the audit plan. So let us suppose that you want to check the existence of the bank balance and then you have mentioned that let us suppose bank confirmation is something that you will be performing as a procedure. Okay. Then the audit procedures will definitely be telling you that this audit plan will definitely be able to showcase that the complete audit procedures and how they are mitigating the risk that we have identified. So planning for these audit procedures takes place over the course of the audit as the audit plan for the engagement develops. He asks Megha and his audit team to work on planning the nature, timing and extent of specific further audit procedures and Saurabh on planning of risk assessment procedures. Okay. So the NTE is what Megha is doing, while the risk assessment procedures is something that is Saurabh is doing. So, what are the various processes the company has in place? You know, what are the various assertions that we need to identify to the significant class of transactions, account balances, etc. What are the audit procedures you will be performing to mitigate that kind of situation? So that is all Megha and Saurabh they both are working upon. Further, CA Krit knows that the overall audit strategy and audit plan should take into consideration the element of materiality and its relationship with risk and procedures to be adapted. CA Krit has already developed an audit strategy and while a detailed audit plan is being developed. So CA Krit, he knows that whatever the audit strategy or plan he will be making, materiality can play a very big role. Okay. So I mean, materiality, obviously, if you want to test, let us suppose a class of transaction or account balance, you need to see whether it is material or not. So, basis the materiality, there will be a lot of dependency on of the nature, timing, extent, audit strategy, audit plan. It will be having a good extent of dependability on materiality. So he decided that the mortality levels set earlier needs to be lowered as weakness in the internal controls were highlighted in the internal audit report. So CA Krit now he has started going through the internal audit reports and then he realized that the internal auditor has given some kind of observations or findings on the internal controls. So since CA Crit is able to see that there are some internal audit findings which are there, so he realized that the audit materiality should be reduced to mitigate that kind of a risk as well. And if he is reducing the materiality, it means the audit procedures extent has to be increased. I mean, we need to perform more audit procedures because there is a lower materiality which is there. It means you have to change the audit plan and audit strategy to cope up with the revised materiality. So subsequently, a deviation from the audit strategy is felt necessary and he is stuck in a dilemma as what to do first, modify the audit strategy and then revise the audit plan or vice versa and seeks partner CA Nitin's suggestion. So CA Nitin, he may be an EQCR partner, which is the Engagement Quality Control Reviewer on the ABCD Limited, while the engagement or signing partner is CA Krit. CA Nitin is also there to advise. So now Mr. CA Krit is thinking that there is a change in the materiality and this may result in the change in the audit strategy and audit plan. So he is not sure whether to change the plan first or to change the strategy first. Okay. Strategy comes first. So if you really want to change anything, the strategy has to be changed first. But let's see what kind of questions the questions are there in the case study, and then we need to draft our answers accordingly. But this is the kind of a situation. So in this question, I mean these kind of questions when you will come across these situations, and this is a very detailed kind of a question. There are multiple such situations which requires your attention. So what you can do, you can probably on the question paper or somewhere on the answer sheet, you can make a summary. You can just mention that this particular para relates to these kind of situations. So that when a question is asking for a particular situation, you need not to go back to study the whole case study again. Okay, because time is a very, I mean, important factor which is there. So time is something which is on stake when you are appearing for CA final examination. So attempting all the case studies within the given time period requires you to be very vigilant and to be very proactive in terms of making summary or kind of like taking the command over the case study in one reading itself. It is the question or the situation will not allow you to go through multiple times from the case study, right? So make notes and then keep on highlighting, keep on mentioning in the question itself about the situation that the questions are explaining. Okay. So like over here, if you see, first of all, about the GST. So Rahul is pretty much concerned about the GST provisions, and then ABC Limited, this company. So first question was about the barter kind of a transaction whereby one property is given in exchange of another property to one of the director. This was the first situation where a consultancy is required. The second is basically that in the Paris there is a new company, wholly owned subsidiary which is started, PQRS Limited, and ABC Limited has sold some goods to PQRS Limited. The the sale happened in euro 13 lakhs and the cost was 936 lakhs, and this all is staying in the books. So PQRS Limited has not sold anything. Now there are few consultancies. The first one is basically about a three-party transactions whereby a Singapore vendor has directly supplied goods to the B dealer in Greece, and Singapore has billed to ABCD Limited in India and ABCD Limited has billed to dealer B in Greece. The second question is about a fashion show which is going to happen in Italy and the merchandise which are being sent along with the team by Rahul. to that particular Italy show. And simultaneously, he also wants to know that what are the situations in which the domestic sales can also be considered as the export sales. A chief accountant is also there, which is basically asking that there are two situations. One is whereby they are filing an export bill of entry, which means they want to release the goods from the warehouse goods for home consumption. And in one situation, they have directly sold the goods without really getting them released for the home consumption directly to the Panacea Limited, another company. And the bill of entry is also filed by the Panacea Limited. So company has sold them without clearance. Then there is an statutory auditor, which is like CA Crit, and he has come across a situation whereby the materiality has to be revised. So he is confused whether the audit strategy is something that he need to revise first, or then he need to work on the audit plan. Okay? So this is the complete question basically. These are the various case studies, various situations. Now let's go back to the questions. The first is basically the multiple choice questions. The first question says, which of the following is responsible for issuing granting IEC, Importers Exporters Code? IEC is required if you want to do import or export. Okay. So for this IEC codes, there is a DGFT, which is the Directorate General of Foreign Trade under the Ministry of Commerce and Industry. This is the department, this is the ministry which controls the IEC codes, right? So the question is, the first question is basically that who is issuing it? So I told you the answer. Let's see the answer as well. So you see, the answer to the first question is Directorate General of Foreign Trade under Ministry of Commerce and Industry is responsible for granting IEC. It means the B is the correct answer. Let's move to the next question. The next question is, what should CA Nitin advise CA Krit to do when the latter is stuck in the revision dilemma of maternity levels set earlier? So I told you the overall strategy comes first and then you can revise the audit plan. So it says like firstly modify the overall strategy and thereafter prepare the audit plan in line with the strategy. B says prepare the audit plan and then modify strategy. Modify audit plan and strategy together. Go with change in anyone as these are not interrelated. So the answer is obviously answer to this question is A, whereby you need to modify the strategy first and then thereafter the audit plan. The reason is, which I have already explained, but let's go through with this, that CA Crit should firstly modify the overall strategy and thereafter prepare the audit plan in line with the strategy. This shows that the audit strategy and audit plan are closely interrelated as change in one is resulting into change in other. Okay. Next question is, they have given you two statements. So you can see that what type of multiple questions can also be there. I mean, there are various ways through which the multiple choice questions can be presented. So somewhere you will see it's just like the multiple options are given. Sometimes you have to calculate to calculate the answer, the correct answer. At times you will realize that these kind of statements are given. Like two statements are given and then the options which are given is basically that which statement is true. One or two or both or no, nothing. I mean, so these kind of options can be there. So in the third question, there are two statements. The first one is GST is leviable on the fabric imported from Paris while filing for its clearance. The first is says that when you are filing for the clearance from the imported goods from Paris, then GST is leviable. Second statement is saying that GST is not leviable on the sales made to the Panacea Private Limited. So in the second situation, you see, we have not applied for release of goods for the home consumption. So we have just sold it from the custody of the custom itself. So it is like I have not done the clearance for the home consumption. So obviously the GST is not applicable. GST is only applicable when the goods are cleared for home consumption. Okay. So in the first question, it says like GST is levied on the fabric imported from Paris while applying for clearance. Yeah, true. The statement is correct. The second statement is also correct. Okay, but they are independent of each other, obviously. So if you see in the options, the option that we have is B. Both the statements are correct and they are independent of each other. So this is the correct answer. Okay. Fourth is, it says like, considering transactions with Mr. T, one of the directors of the company, which of the following statements is most appropriate? So there are four options that are given. The first option says the transaction with Mr. D is permissible, subject to certain conditions laid down, and there is no doubt in it. So this statement is true. But let's read what it says is, however, the company is not acting in accordance with the law by approaching a valuer referred to in the description. Such a valuer needs registration from the Institute of Actuaries. So the question is absolutely, the option is absolutely correctly here. The only problem with the first option is that it says the valuer needs to registration from the Institute of Actuaries, while the Act says that they need registration from Insolvency and Bankruptcy Board of India, okay, to act as a valuer to value the property in these kind of transactions. So if you see, there is only one option out of all four options, because the first is the actuaries. The second says that uh, the company is in accordance. The third says the insolvency and the bankruptcy board, and fourth says the institution of engineers. The correct answer is, as I mentioned, is the insolvency and bankruptcy board of India. So we have this as the only option C, where it is mentioned that the valuer has to be registered with the Insolvency and Bankruptcy Board of India. Okay, so in this case, this is the correct answer. Yeah. So over here you see the C is the correct answer because it's the Insolvency and the Bankruptcy Board. Now we can move to the fifth question, which is again the similar kind of a setup whereby multiple two statements are given, and then they'll be definitely asking you which one is correct and which one is not correct. So statement 1 says, in case of trade involving B in Greece and C in Singapore, invoicing should not have been done by ABCD Limited in India. I mean, this is a wrong statement. As I mentioned, basically, that if you will not do this, you will lose the uh, customer, the client. These are business secrets, and these are set practices through which you save, I mean, customer contact, right? Otherwise, C will get the customer contacts, and then they will start directly billing the B in the Greece, and then there will be not any benefit of the customer. The company will start losing the business itself. The second statement says that value of such shipment has to be included by ABCD Limited in the value of exempt supply for the purpose of reversal of ITC. This is also not true, because this is not the kind of a transactions which are exempt supplies. This is not an exempt supply. Okay, to for the purpose of reversal of ITC. So both the statements are incorrect. The answer is this. Let's read the reason, because it at times becomes tricky. So these kind of reasons which are mentioned here in the answers, they also gives you better insights. They gives you good insights so that you know how the situations, these kind of situations can be handled. The reason for this is third country shipments or triangular trade. Remember these words. So this is the third country shipment or triangular trade. It means there are three parties involved. Okay, and it is a common practice in international trade whereby goods move from one country to another without touching India. It means from Singapore to Greece directly without touching India. Only invoicing is done by the registered person in India. Paragraph 7 of the Schedule 3 to CGST Act provides that supply of goods from a place in the non-taxable territory to another place in the non-taxable territory without such goods entering into India, third country shipment, is treated neither as a supply of goods nor a supply of service. This is not a supply of goods or service. Thus, there is no GST liability on such sales. So, if you are doing a triangular trade, there is no GST liability on such sales. Further, value of such country shipments is not included in the value of exempt supplies because this is not considered as a supply under the GST Act, right? So this is not included in the exempt supplies as well for the purpose of reversal of ITC under that. Yes, this is the reason basically, and that's why both of these statements are incorrect. Okay. With this, now we have to move to the descriptive questions. So the descriptive questions in this given situation, they are also very important because you see there are multiple issues or concerns that are raised by the customer, multiple clarifications that they are seeking. So let's see in the descriptive questions how things are, what type of questions are there and how to handle them. So in the sixth question, it says like provide the accounting treatment with respect to transactions between ABCD Limited and PQRS Limited in their respective books of accounts. Also show its impact on consolidated financial statements. Support your answer by journal entry wherever necessary in the books of ABCD Limited. So exchange rate on 1st January when the sale was made is 83 and at the closing it is 85. Remember, when you are selling goods in the standalone books, ABCD will recognize this as a sale in at 83 rupees, right? While PQRS they will recognize as purchase, but there is a euro, right? So for them, 83 does not matter because their PQRS Limited's the functional currency is euro only. At the year end, now, since there are no payments that ABCD Limited has received, all these sales are still due for the collection. So whatever debtors, the number of euros the ABCD Limited is having, they will reinstate it at the year end and will recognize 2 rupees per euro as a unrealized gain. So there is an inflation. So there is a increase in the price of the debtors happened just because there is a change in the foreign exchange rate from 83 to 85. So 2 rupees of unrealized gain that has been earned by ABCD and then they will recognize this in the books. But when it comes to the consolidated financial books, you know what will happen? ABCD Limited and PQRS Limited, they both are the same company. So the receivable and payable, they will um, adjust with each other, they will nullify in the books, and the inventory which is there, right, it has to come down or it will be recorded at the cost or NRV, whichever is lower. So if there is any unrealized profit on that inventory which is there in the books of PQRS Limited, that will be removed from the situation. So this will be the treatment in the consolidated financial statements. So let's see how the answer of this kind of a situation is given by the question. So you see the question answer to question number 6. This is the exact same thing that I have just explained. Let's see how the entries are being passed. So accounting treatment in the books of ABCD Limited, functional currency is rupees. In the ABCD Limited books, they will recognize a sale of 1079 lakhs. How they have calculated it? 13 lakhs of euro being sold at 83 rupees. Okay. Profit on sale of inventory. The cost of the inventory is 936 lakhs. So profit on sale of inventory will automatically be recorded in the books 1079 lakh minus 936, which is 143 lakh. So profit is there in the book in ABCD Limited book, right? On the balance sheet date, now you see these are the receivables 1079, but they are with 83 rupees as exchange. At the year end, the euro has inflated to 85. 2 rupees of benefit is there. So if you calculate on the balance sheet date, receivables from PQRS Limited will be translated at the closing date, that is 1 euro is equal to 85 rupees. Therefore, unrealized forex gain will be recorded in the standalone profit and loss of 26 lakhs, right? 2 rupees on 13 lakh euros, 26 lakh rupees of unrealized profit by debiting debtors because this is also receivable from PQR as limited. So when I will be making a sale, the accounting entry will be PQR is limited to sales. It will be on 1st of Jan and the amount recognized will be 1079. On 31st March, I will do a recognition of the unrealized foreign exchange gain, which is 26 lakhs. So I'll again increase my debtors, PQRs limited, and I will book the unrealized gain. So these are the two entries that will happen in the ABCD Limited book. In the PQRS Limited books, they will simply recognize the purchase because their functional currency is euro. So in the standalone books of PQRS Limited, they will not be recognizing any expense or any loss of foreign exchange difference because their currency is euro only. So euro to euro, there is nothing that has happened. So PQRS Limited will recognize inventory on 1st of January of euro 13 lakhs, which will also be at the closing stock at the end because they are not able to sell anything, right? Now in the consolidated financial statements, what will happen? These debtors and in the books of PQRS Limited, the creditors will be there. They will be removed. They will be removed. So they will get eliminated. ABCD Limited and PQRS Limited, because now I'm preparing only one financial statement. And simultaneously, the inventory that I have shown, so the inventories, if you'll see, it is the kind of sale that I have just made. The sale has happened 1079 rupees, lakhs rupees. So this 1079 lakh rupees, while the cost was only 936 lakh. So at the year end, this 143 lakh rupees of profit is also there in the consolidated books, which I am just showing like I have sold to myself only because in the consolidated books, this profit is there, which is already recognized. So what I need to do is basically I need to remove this profit as well. So I'll be removing this 143 lakh rupees of profit. So this is another thing that will happen. The closing stock of the PQRS Limited will be recorded at the lower of cost of NRV. The cost is, this is what is assumed, that 13 lakh euros are there and 83 is the rate, 1079. NRV, we are assuming that with 85 rupees, it will increase to 1105 rupees. Okay. Therefore, no write-off is required. The amount of closing stock of rupees 1079 included two components, 936 lakh rupees of costing and profit of 143 lakh. Now it is my one book only. I can't recognize the profit by selling to my subsidiary, wholly owned subsidiary, or it is indirectly, directly, it is like selling to myself. So I cannot recognize revenue by selling products or goods to myself. So in this kind of a given situation, what will happen? I will uh, reduce the inventory and I will debit the P&L because that profit is actually included in my P&L. So I'll remove or reduce my P&L with 143 lakh rupees of notional profit that is there on the closing stock. So I'll remove this. So the accounting entry will be consolidated P&L to inventory. So I'll reduce my inventory at the year end because unnecessarily I have booked my inventory as well at 1079 kind of rupees lakh rupees, and in the simultaneously the profit also was inflated, so I will reduce the profit as well. So this is the treatment of this inventory which is available, right? Very important to remember, in these kind of situations you need to eliminate the debtors and creditors, and you need to eliminate the profit that is there, notional profit that is there on unsold inventory only. Because if there is the inventory, whatever inventory that you have already sold, right, actually that is a realized profit from the third party. So it doesn't matter whether it is in your books from ABCD to PQRS, some portion of profit is there, and then from PQRS to customer, some portion is there. Now you are preparing the consolidated books, so it will get merged or the total profit will be shown because that's the actual profit that we are able to secure from the customer. Okay. The only problem that we face is basically in terms of the inventory which is there at the year end, because that inventory is overvalued because of the notional profit that is there. So we need to reduce the undervalue that inventory by charging it to P&L, and that is the accounting entry which we have passed. Consolidated P&L account to inventory. So I hope there is no confusion on this. Now the next point is basically as regards transaction with Mr. D, one of the directors, state few audit procedures pertaining to transactions to be performed by TA Krit Garg, discuss probable purpose of such audit procedures also. So if you want to audit the transaction that you have just happened, what is that you will like to kind of see as an auditor? So see, as an auditor, if these transactions are happening, I mean, you will see who has valued it. You will get the valuers report. You will go through that report. You will see if it was discussed in the board of directors meeting, if there was a requirement to discuss this with a kind of a general meeting, whether that kind of an approval has been taken or not. So, as an auditor, you will go through with all those procedures which are required, and then you will be making a audit plan around it, right? So, if you see, we will quickly go through that what are the various provisions and how you do this, the audit of this non-cash transaction. So few audit procedures in this regard includes the first one is the management representation. So you can get the management representation as to whether the company has undertaken any non-cash transactions with the directors or persons connected with the directors. Okay. The auditor would need to corroborate the management representation with sufficient appropriate audit evidence. Why? Because when auditor is asking for a management representation is not considered as an audit evidence. You cannot consider this as an audit evidence. So whatever is written in the management representation, you as an auditor have to corroborate it with the other audit evidences. Reference can be made to minute books, which I just mentioned, movements in BPNE, register of the company, and relevant registers and records. So these are the various places where you can see. So the first thing is basically you can definitely ask the management if any such transactions are there. Let the management come back to you and say if it is a yes or no. And then you can also, as an auditor, you generally go through with the minutes. You summarize the minutes of the meetings, and in that those kind of minutes, if you come across any such transaction, then you need to test that as well. The second thing is that the auditor should check compliance with section 192 and verify the notice of the general meeting. That's what I told you. So the general meeting also you need to see if in the notice to the general meeting it was included. Particulars of arrangement along with the value of the asset involved in such arrangement. And value of the asset, you have to check whether the valuer, the report that you have received, whether they are registered with insolvency and this particular act, right? Otherwise, if they are just registered with the engineer board and those kind of situations, that is not sufficient. Okay. The said value of the asset should be calculated by the registered valuer in compliance of company's CARO rules. The purpose of performing such audit procedures could be reporting requirements for non-cash transactions under clause 15 of the CARO. The said clause requires the auditor to report whether the company has entered into any non-cash transaction with directors or persons connected with him, and if so, whether the provisions of 192 have been complied with. Okay. So over here, I mean, three things are mentioned, but as I mentioned, you can add more procedures, including the verification of the background, the qualification, experience of the valuer, and you need to verify the valuer's report as well, whether I mean any assumptions or any kind of attributes that needs to be tested from the open market, whether you have tested that or not. So those kind of things are there. Whether the information that was shared with the valuer was sufficient enough to calculate the value of the property. Is there any information that is being let us suppose not shared by the company, which may have impacted the valuation. There are a lot of things that you can mention if a question is asking about it. Okay. So there are multiple things that can be included over here. Okay, perfect. The next question is basically discuss the implications of proposed transactions relating to sending of company's merchandise for display in textile fair in Italy. Okay, so we have a situation. There is a fashion show or whatever you call it, a textile fair. That's the right word, which is happening in Milan, in Italy. Question is saying, and Rahul is interested, ABCD Limited is interested in sending some merchandise for display in that textile fair. So the question is asking, what are the implications of this kind of an arrangement? Further, also discuss under what circumstances goods sold within India can still be categorized as exports under GST law and also touch upon taxability of such transactions under such law. Okay, so there are two situations. One is what will happen to the goods that you are sending for display in the textile fair? And second is, what are the situations or circumstances in which supply can be considered, selling inside the India can be considered as export. Okay, so we will address them. There's a detailed response to this question, and let's see. The answer says that export of goods or services are treated as interstate supply and zero rated. This means that even if there is full exemptions for the supply, ITC is still available to the exporter. The exporter will have an option to either pay IGST on the output supply and claim refund of such IGST paid, or export under bond or LUT without payment of IGST and claim refund of ITC. The objective is to make Indian exports competitive in the international market. It may be noted that since exports are interstate supplies, the tax associated with them will be IGST. Okay. Now the answer says that they have two options. Either you will be paying IGST and then later on at a stage you will be applying for refund, or you can export those goods against a bond or LUT, letter of undertaking, that these are the goods that they are being sent only for display purpose, and then these are not the sales. Okay, so this is kind of a situation. In the first part, it says like Rahul has purchased a license to put up a stall in the textile supermarket global fair to be held in Milan, Italy, and he wishes to send his team to this fair along with their company's merchandise to display over there for promotional purposes. Sending, taking goods out of India for exhibition or on consignment basis for export promotion. It is allowed. In this particular circular, it has been clarified that the activity of sending, taking goods out of India for exhibition or on consignment basis for export promotion, except when such activity satisfies the test laid down in Schedule 1, does not constitute supply, as the said activity does not fall within the scope of this, as there is no consideration at the point. So this is not a supply. In simple words, this kind of a transaction, it is just like you're sending merchandise for display, so it is not considered as a supply. Since such activity is not a supply, the same cannot be considered as zero rated supply, because something which is not a supply cannot be treated as a zero rated supply as per the provisions contained. Thus, activity of sending, taking specified goods outside India is not a zero rated supply. That being the case, execution of a bond or LU2T letter of undertaking as required under section 16 of the IGST is not required, because this is not a supply at the first instance itself. Okay, so the answer is basically in the first instance that since this is not a supply, so this is a zero rated supply. You cannot just name it as a zero rated supply because it's not even a supply. The second part is saying this basically that what are the situations under which domestic sales can also be considered as the export. So he had heard from a dear friend that he could sell the company's products within India, and these still can be categorized as exports. It takes place in deemed exports. So in the GST, it is known as deemed export. Deemed exports refer to supply of goods manufactured in India which are notified as deemed exports under Section 143. Such supplies do not leave India and the payment for the same is received either in Indian rupees or in convertible foreign exchange. It means they are simply sales within India but to some specified associations or buyers, and in those cases it can still be considered as export. Okay. Following categories of supply of goods have been notified as deemed exports by the government-wide notification list. The first one is supply of goods by a registered person against advance authorization. Under the advance authorization scheme, if there is any supply of goods by a registered person, that can be considered as deemed export. Second is supply of capital goods by a registered person against EPCG, Export Promotion Capital Goods Authorization. Third is supply of goods by a registered person to EOUs, or fourth is supply of gold by a bank or public sector undertaking specified in notification. This one against AA, again advance authorization. Okay, so in most of the cases, generally, all those transactions which are happening for the export oriented units or the advance authorization kind of situations, whereby your goods will be used to produce some further goods which will be ultimately exported. In those questions, your supply can also be considered as an export, but since it is a sale within India, so we don't consider or call this as an export, but we call it an deemed export. Okay, so that's the word that you need to remember. Taxability of deemed exports. How you tax the deemed exports? Deemed exports are not zero rated supplies by default, unlike the regular exports. So they are not like it's not like you are just doing regular exports. They are not zero rated supplies. So in generally in these deemed exports, you need to pay the tax and then later on you need to claim the refund. Hence, all supplies notified as supply for deemed exports are subject to levy of taxes. Such supplies can be made on payment of tax and cannot be supplied under a bond or LUT. You need to pay the tax and then you need to supply. However, the refund of the tax paid on supply regarded as deemed export is admissible to either the supplier or the recipient. Thus, the application for refund has to be filed by the supplier or the recipient, subject to certain conditions of deemed export supplies as the case may be. So, in the taxability of deemed exports, you need to make the payment and then later on you can claim the refund of the tax. Okay. So I mean, in the second kind of the case study, you see, we have discussed a lot of things, and from the IEC code we discussed about difference between overall strategy and overall plan. We also discussed a lot of about concepts under the GST framework, especially triangular sales, which is basically a sale without touching the Indian border from one place to another place. We have also seen a non-cash transaction between the director and the relatives as per the Companies Act, right? There is also a kind of a discussion around the 100% subsidiaries, their consolidation, and the elimination of the notional profit that is at the closing stock. Again, remember any inventory which is supplied and sold to the ultimate customer, there is no need to remove the profit which is there, because ultimately that is the realized profit. It is just the notional profit on the closing stock which we need to remove, because cost or analysis whichever is lower. And then we did discuss about the how to audit non-cash transactions and what their implications in the CARO reporting. Okay, and then the last that we have discussed is about the deemed export and how to have the taxation around the deemed export. So I think in both the case studies we covered many concepts, and with this we have come to an end of today's session, today's both the case studies. And team, I would like to go back to you. Do we have Deepak ji with us?
No, sir.
Okay. Okay, then let me just quickly check if we have any questions in the chat box. Okay, so for the time being, there are no questions in the chat box as well. So I wish all the very best to all the participants, and I look forward to connecting with you soon again with another case study. Thanks a lot, everyone, for your time, and all the very best for your exams.
Over, sir.
Over, we can close this for today's session. Thank you,
Thank you,
team.
sir.
Thanks a lot.